Okay, hey, Ryan here with Bond Street Mortgage, and we have James D. Piazza, founder and CEO, to give us the weekly mortgage update. Hey, James.
Hey Ryan, how are you?
Good. So you just sent me this fun graphic here. You want to go into it and talk about what's going on with rates?
Sure. So what this graph shows is that for the year we are at the low for interest rates. So we've kind of over the summer, if you look back towards July, sort of in this range, and things went back up to the higher side of this chart here, and now have started trending down. If you look on the left side, that's really the most interesting part of it. Is you'll see last summer we were close to 1.5. This is a chart of the 10-year Treasury bond, by the way, which does dictate the 30-year mortgage rates in this country. So last summer we were really at all-time lows. Historical lows. The 10-year hasn't been much lower than it was last summer. And then as you see, as we're getting closer to December, if you can see there on the there's a sharp jump up before December 1st, which that coincides with the election. So the day before the election, the 10-year bond was 1.8%, and within a week, it was 2.25%. Yep. So super amazing jump up when you consider that the U.S. bond market is the most liquid market in the world. Treasury bonds are not supposed to trade like Bitcoin. They're supposed to be very stable, and so it was a real surprise to all the markets, and especially the bond market. And what the thought process there was that with Trump coming into office, administration, and also control of Congress, that the Republican Party would be able to follow through on all of their great ideas from the previous 8 years, which they blamed on the Obama administration for not being able to get done. And so we kind of stood at the higher levels. I mean, I think we went up as high as 2.6% on the Treasury bond. And again, if you're going basically from last July to March, so about an 8-month period, and you have a full 1% gain in a Treasury, in the 10-year Treasury bond, that is probably for those of you that may have been in the business or purchased a home back in 2013. That's when taper tantrum happened, when the Fed said they would first start reducing the asset purchases of the bonds and the mortgages, and things shot up. So this was a very similar event to that. And through March, we felt that that we're still going to get some things done. And of course, then the political turmoil happened, the failure of Congress to do anything on healthcare reform, and the continuous bipartisanship that or partisanship, I should be saying, in Washington. We've slowly coupled that with some, not still, I've said it before, as far as the economy goes, some good numbers, some bad numbers, but the euphoria, I guess, of the new administration has definitely been wearing off. And again, there's no sign of inflation. So from an interest rate perspective, we're at year lows. We have not. So the interesting, also technical side of this is that left side where I said the day before the election, we were at 1.82 on the Treasury bond, which equated to, for a mortgage of $424,000 or less, you were around 3.5, 3.6, 25%. And today you're at that 3.75 or so level. But so if we have a very good chance of retesting that low, because the jump was so quick. There is very little support. If you look now all the way to the right, there's very little support on the way up to that next point down, which is about that 180 mark. So it's a very interesting time, and it looked like last, especially in the beginning of the week, that we might have some pressure to the upside. From an economic standpoint, it looks like things have cooled off overall. So, there's no major catalyst for inflation, and now everyone does pretty much believe that the Federal Reserve will not make another move the rest of the year. So here we sit at about 2% or so on that 10-year bond. So it's a great time, and I can't remember the last time that Two things happen during the summer and what we call the spring market in our business, and that is, number one, interest rates went down over the course of the spring market. Typically, usually it goes the opposite way. Obviously, the big market investors that can shift the bond market with their money, they tend to try to get it to go the other way during the spring market because they know that's when the most mortgages are done, and they know that, look, if you're buying a house, 0.25% on an interest rate really doesn't mean much to you, but for J.P. Morgan Chase or any of the investment houses, Morgan Stanley, et cetera, 0.25% on a portfolio makes a big difference. So they tend to go higher, and they didn't. And the other thing for all of us, obviously, you saw gas prices went down, which never happens during the summer market. And why is that important? Commodity prices, right? So there is just not a sign of inflationary pressure yet in the economy. And again, you couple that with the Amazon effect. They bought Whole Foods. The first thing, they just closed that deal a couple weeks ago, I believe, and the first thing they said is, "Hey, all the prices are going down at Whole Foods." So you throw in the Walmart effect, the Amazon effect, lower commodity prices. Wages have not grown for the average person through this recovery since the financial crisis. So all those things point to lower inflation, which means this 10-year Treasury bond should stay on the lower end, and it was more of a knee-jerk reaction. And if we can get things like tax reform done, which would give Americans some more discretionary income, that may ultimately send things the other way. But right now, it's not a political statement. I'm an independent by nature, but it's just more of the same as far as Washington goes, regardless of who has control and what administration it is. There's just no pro-growth, or at least initiatives that are, really going to affect the American people to say that, hey, this is the next, prospect for growth in this country. It's hard to say where that's coming from. Technology, is especially the social media aspect. That cat's out of the bag. The Nasdaq is at all-time high. So where do you go from here? And we're definitely at a crossroads. But it's a very healthy spring market, very low inventories. We talk about affordability. This will help buoy home values because interest rates will remain low. So that if it would be a very good time to refinance, consolidate some of that high interest debt because homes have appreciated over the last 5 years or so. And if you're out there buying and you didn't need to pull the trigger over the spring market, you can get aggressive maybe on some of those offers because, again, through the spring market, we've come down, a good 1/4 to almost 0.5% in interest rates. So it's definitely there's some value, some cheaper money out there today than there was, 3 months ago for sure.
So it's a great time to refinance. You mentioned consolidating other debts. I don't think a lot of people think about this, but there are programs that will let you, they'll let you take the equity in your house and kind of roll in student loan debt and other things.
Yep. So there is a program specific for student loan debt where you can pay off your mortgage and student loan debt. So what happens is when you're refinancing for a lower rate, or term, you're typically going to get better refinance terms. If you're looking to take equity out in a cash out event, typically that interest rate runs a little bit higher. But if it's student loans, it won't count against you as cash out. It'll count, you'll get that rate and term interest rate. So you'll save, depending on credit score and loan to value. I've seen scenarios where you've been able to consolidate those student loans and get about 0.5% better interest rate as comparable to a cash out mortgage.
Great.
But even if you're at 3.75, let's say today, many people are under 4%, right? Because interest rates have been so low. But you have 40,000, and this is a fresh scenario on my mind from this morning, 40,000 in credit card debt or student loan debts, and you can still today consolidate that around 3.75, and maybe even you've had that mortgage for a couple of years, so we can actually bring it down to, let's say, a 25-year term, so we're not adding years back to your mortgage and still lowering your overall payment and cash flow. That's a scenario that's very common today, and people don't think. We even have, we can even give you a term based on the exact amount of payments that you have left. So, for example, if you have 23 years left of payments, we can initiate a new mortgage on a 23-year term. So, it makes a lot of financial sense, because obviously you don't want to add that interest back on just to save a few dollars today. But if you're at a comparable interest rate and you have that high interest debt or student loan debt, you're talking about, in the scenario that I looked at this morning, it was about $400 a month in cash flow, and it came out to over 30 years. It was 125, over 125,000 in interest savings over 30 years. So
That's really cool. And you just brought up something I wasn't aware of. And I think a lot of people who might have refinanced once in the past might think about refinance and say, yeah, I went back to 30 years again. I don't want to do that. So the fact that you can actually just stay right in your, lock in the amount of time that you've already earned paying is really cool. So to repeat what James just said, if you've paid off 7 years of your mortgage, you don't have to go back to add another 7 years back on when you refi.
That's right.
Yeah.
Because it's nice to say I save $300 a month, but over the life of the mortgage and considering what you've paid into it, obviously, what does that savings look like? And that's important to analyze the term.
So you could also go the other way, I guess, and maybe keep the same payment but shorten your term. So if you find that you can get a lower rate, maybe you're on a 30 now, maybe you can go down to a 20 and find it's not much more expensive.
Absolutely. Let's say if you're at a 30-year rate today in the mid fours, which there's plenty of people in that range also, and you can go down to a 20 in the mid threes today, because you're going to get a better interest rate on a 30-year than a 20-year. Your payment may be slightly higher, but the interest savings is tremendous.
And you bought 10 years.
Maybe on a $2,000 a month payment, it might be $100 more a month, or $100 or less a month more. But if you're talking saving 7-8 years of your mortgage payment at $2,000 a month, that's 180 grand or so that you'd have in 175,000 in interest savings.
Yeah. So in terms of retirement planning and longer term outlook, I mean, that's a no-brainer.
Absolutely. That's what I was going to say. That funds your retirement, funds your IRA, $200-300 a month, $3-4 grand a year that you're saving. Put that into your IRA for the next 20 years with compounded interest. I bet you'd have a couple $100,000 there and return in the markets. You'd probably have a couple $100,000 there for your retirement instead of giving it to whoever you make your mortgage payments to.
Great. I'm going to share that with some friends. James, I hope you write a blog post about that specific one. Maybe we can get some case studies, some of the math behind that, a scenario or two. Yeah,
I'd be glad to. I'll throw up a mortgage coach presentation on the blog and share that link with everyone, and you can go ahead and take a look at that comparison.
Great. Okay, so bottom line, rates are still super low. They might not always be. It's kind of a no-brainer if you're thinking about refinancing now. If you're on the fence about buying a house, I mean, it doesn't get any better than this still.
Yeah, I would say, over the last few years, especially the message has been for higher rates, and we would see higher interest rates. And it looked like that was finally happening this year. Again, because of the election results, and the reality sets in, and the numbers take over for the emotions, and that's what we have to look at. And again, overall, economically, I think we're in a good place. We're probably still growing 2% or more, or 2.5%, which is a very comfortable place for the economy. But 3% would be a little bit better. And so typically that's what the 10-year also tracks is, our GDP. So if you look at the estimates earlier on in the year, because of some of these initiatives that we thought would get through in Washington, that there would be a little bit more growth in the economy. And again, reality setting in, it's just more of the same, which is a lot better than, a recession or negative. And I think overall, you look at consumer sentiment is very good. Business sentiment is very good. Jobs are okay. Where we have full employment in the economy, but again, the wages are low, and that's probably the biggest drag on housing today, because the programs are out there, I think, for most people to be able to at least get a mortgage, or at least for those people who should get a mortgage. So it really comes down to the affordability aspect, and with the low inventory and the spring market, we've definitely seen, definitely a seller's market this year, no question.
Yeah, and a lot of people. So, kind of what you're saying is a lot of people who have a steady job, their income might not match the area they live in anymore. They might be getting priced out of housing.
That's right. Yeah.
So, so I guess talk to an agent. If you find yourself in that situation, there are still areas you can buy. You might have to go a little bit outside of your desired town, but you might also find an opportunity for longer term appreciation because there are going to be other buyers thinking the same thing.
Yep.
Yes. So
if you're in an area that's super hot and has been, and the affordability is way low, there's definitely neighboring towns or something, real close that, like you said, that town has been appreciating and is super hot, and it still might see 2, 3, 5% appreciation, but you can go maybe 20, 30 minutes away from that area and have the opportunity for 30, 40% appreciation over the next 10 years or so. So
yeah, the better opportunities are there, and your agent's going to know. If you talk to a good agent, they're going to know exactly where to tell you to go.
Absolutely.
Yep. All right, great. Anything else, James? Or are we good for this week?
Just say to all our friends in Florida, stay safe and stay out of harm's way. Obviously with Harvey, Houston, I know we've contributed some. We'll continue to do more, and our hearts and prayers goes out to everyone. And just stay safe. I know you're right in the storm's path there, maybe a little bit west of it, but just your friends and your family. Hope everyone stays safe.
Well, thanks. Yeah, I was going to leave town, but I figured if the power goes out, I get a few days off work, So, all right.
Don't you got one of those bikes so you can crank it?
Yeah, I'll make the kids ride the bike so we can do next week's update. All right. Thanks, James.
Thanks so much. Talk to you soon.
Yep.
Bye.
Bye.